Hello, everybody. Welcome. Tesla stock is down about 0.6%. It was down a few percent this morning, recovered throughout the morning, and now just below the break even. Overall markets are up slightly. Dow Jones up 0.3% because of Nvidia. Nasdaq up 0.2, S&P 500 up 0.2. Nvidia is up about 4% today. Except for Nvidia, the averages would have been down. Dow Jones is also benefiting from a bounce in UNH, United Healthcare. Let me do a sound check real quick. Let me know in the replies to the X space and in live chat on YouTube. Let me know how the sound quality is. YouTube is good. And let's also see X. Sound quality on X is, I guess I'll find out soon. All right. Um, Today we have again, NVIDIA is bouncing quite a bit today, up about 4%. I increased my NVIDIA short position today. And all right, good. Looks like sound quality is good on both platforms. I increased my short position on Nvidia today. I think the stock is very overvalued. Um, I think the company is going to see increasing level of competition from other chip makers as well as internal developments at megatech companies. Microsoft, there was a graph circulating today that I can maybe pin up here at the top of our screens. So here's the graph, and I'll show this on X as well, on YouTube as well. Microsoft bought twice as many NVIDIA Hopper, so this is H100s, H200s GPUs, as big tech rivals in 2024. Meta bought 224,000, Microsoft bought 485,000, and then Amazon 196, Alphabet 169,000. Alphabet, of course, has its own TPU development and uses that for Waymo, Gemini training, as well as for Google Cloud, and complements it with purchases from NVIDIA. And I think it's notable that let's bring in Tech Greg, XAI, and Joey up to speaker board, and maybe learn code if he's available, and anybody else who wants to talk about Tesla or other stocks. I think it's notable that Meta, Facebook, has the best open source models that keep toe to toe, essentially toe to toe. I mean, an average user wouldn't be able to tell the difference um, versus closed models. And despite Microsoft's massive purchase, Gemini seems to have. So OpenAI uses Microsoft's training clusters to train ChatGPT. Google uses mostly its own TPUs to train Gemini. And Gemini is now ahead, according to some folks, ahead of ChatGPT, which is incredible, right? So it seems to me, at least on the application side, NVIDIA's GPUs, I don't think they allow the end user um, an insurmountable lead when training models, AI models. And I think that's a very profound observation. I think this is a very important observation when it comes to NVIDIA's demand and competitive advantages and margins going forward, pricing, and therefore its valuation. I think Nvidia is going to see the biggest drawdown in market cap in stock market history. Today, it trades at about $3.4 trillion of market cap, which is incredible. So I increased my Nvidia short position. Let's see what else is new. There's a congressional debate going on in extending um, continuing resolution, prevent government shutdown. We'll see how that goes. I don't think the market currently expects the government to be shut down, even temporarily, but we've been here before, and it doesn't seem to have a lasting impact on markets. Maybe some short-term volatility around it. Broadcom is down 3.4% today, on top of a big drop yesterday as well. So that was a very quick rise and fall. I'm negative on the entire semiconductor industry, not just Broadcom. Um, all right, let's see what else. Microsoft dominates NVIDIA GPU purchases in 2020. We just talked about Microsoft is also running out of, or they have a cash balance that's declining, which is pretty amazing. So it kind of calls into question how much they can keep this up. I mean, almost 500,000 GPUs. Let's see how much that costs approximately. They're priced between 27 to $40,000. So you're looking at approximately close to $20 billion of expense. $20 billion of expense, capital expenditures from Microsoft to Nvidia. All right. The strategic move has alleviated Microsoft's previous chip supply constraints, as confirmed by CEO Satya Nadella, positioning the company as a leader in AI technology. Other tech giants like Google, Amazon, ByteDance, and Tesla also invest in NVIDIA's GPUs, but in smaller quantities. This investment underscores Microsoft's commitment to enhancing its AI infrastructure. I mean, the other thing is obviously one of NVIDIA's other biggest clients is Amazon, and now they have their own training computers as well. So Alphabet has its own development of training compute. Amazon is making progress with that quite a bit. Um, Microsoft is has declining cash balances, so they're not going to be able to keep up the space. And I don't see how smaller buyers um, can replace the top buyers of Nvidia in 2022 and 2023 and 2024. So I think Nvidia's growth and margins will decline at a much faster rate than people realize. US housing data starts to drop, permits rise. This is a very volatile type of thing, so I'm not too worried about it. Today we have the federal funds rate decision. The CME Fed Watch Group shows nearly 100% probability of another rate cut, 99%, and 1% probability of a pause. What's going to matter is more the press conference. So I'm going to tune into the press conference for the first half hour at the end of the space. So that's going to happen in about an hour. We can watch that together on YouTube. Tesla FSD 13 rollout is expanding to about 10% of the eligible fleet, according to About Tesla. Um, I think he only looks at AI for, let's see, another wave just went out. This is as of yesterday night, last night, almost midnight. Another wave just went out. FSD 13.2.1 has now been released to 10% of the Tesla's fleet in the US and Canada, almost 75% of the eligible hardware for vehicles. So 10% of US and Canada fleet. So we're looking at a couple 100,000 vehicles. And Tesla FSD tracker is getting more V13 data, but it's still not a significant amount of miles or entries for V13. So I would advise not using this data just yet. There's 255 miles and 24 entries on V13, but I'm waiting for this to hit tens of thousands of miles. So that's not going to happen this year, probably next year. Any other questions, comments? Please request to speak. One thing I'm researching these days is similarities, comparisons, and contrasts between today's economy and 1995. There are a lot of similarities. One difference is the inflation rate is running a little hotter today than it was in 1995. So I think that kind of limits what the Fed can do. So we're going to get more information about that today during the press conference, and we can put down some predictions heading into it to kind of measure our understanding of it. Lauren Code, go ahead.
Hey, and I just had a quick question. Sorry for asking this, but does anyone by any chance happen to remember the episode of where the FSD tracker guy came in? Because I have a few questions, but I don't want to ask them if they've already been talked about.
Yeah, and I can always bring him back again. What's your question?
I had like a list of a few questions, but I don't really want to ask them now because I kind of want to like go through them and edit them and just make them brief and concise. And I just wanted to see if you already talked about
Well,
it.
what are the questions?
Um, well, the first one was not directly related to the tracker. It was about you said Tesla needs to be 1,000,000 miles before an intervention. Um, I think the average driver is 500,000. Is that correct? Where'd you get 1,000,000 miles from?
A million miles is in Europe. In the US is about 500,000. But also consider the fact that some of these ADAS systems are going to continue to improve. So I think overall industry miles between critical interventions or accidents will increase in the future.
Now, I read that
And then on top of that, Tesla plus um, ADAS obviously has way better than 500,000 miles between critical interventions. So
yeah, but I think it needs to go with the average driver. Um,
why?
well, if you have safety critical software that is better than 50% and safer than 50% of the population, I think that's a good benchmark. Why wouldn't you want to be that would increase the safety, not decrease.
I mean, you can make the same argument today that as long as a Tesla robotaxi is safer than some, like say the bottom 10 percentile, doesn't have to be average or 50 percentile. You can say 10 percentile, and you're still increasing safety for those drivers. But I just don't think the widespread nationwide adoption is going to happen, even when you just kind of cross human safety. I think you're going to have to show indisputable data that is better. And one way they can do that today is if they limit the operational domain, like Waymo is doing with certain geographies, as I guess Tesla is also looking to do now with Austin and LA. But that's why I say nationwide adoption, because if it's just in two cities, I don't see how that's material for the stock.
Yeah, I don't think it will roll out that way. I don't think it'll just be two cities. And I do think worst case scenario, they can kind of limit to easier areas. Um, but I believe Waymo, correct me if I'm wrong, is one crash per 100,000.
But they have, teleoperators, right?
Waymo? Yeah, but it's still one
Right.
crash per 100,000 with, you know, either way, right?
Hold on one sec. Um, where did you get to 100,000 miles?
I believe that's on Waymo's website. I'm looking that up right now.
Yeah, but it's not, like I said, it's not nationwide adoption, right? It's only a couple of cities, and they're losing billions of dollars. So is that the kind of metric that you want to beat?
Well, I think Tesla will be held to the same standard as Waymo, but I think even though Waymo is not nationwide, um, I think once Tesla starts rolling out, uh, if Tesla's doing better than Waymo, I think they'll be in all the cities that Waymo's in, and more. And
But how are
I
you going to
think they'll hit a
scale
lot of
that? Like,
easy
how are you going to?
areas.
So let's say Waymo has 1,000 cars, and they have dozens of teleoperators. How are you going to scale that? You're going to hire thousands of teleoperators for Teslas?
Well, that's a good point, but I think that's yet to be seen. I don't think, and I don't know, but I don't think Tesla is going to rely on teleoperators the same way that Waymo does.
But then you can't use Waymo safety statistics then.
Well, teleoperators don't make Waymo safer; they just get them out of like non-critical disengagements. That's my understanding because the latency is too high to intervene mid-crash.
Yeah. And Waymo also has HD maps, which obviously Tesla doesn't have. So I think there are factors at play here that kind of allows Waymo to start a service at a reliability level that um, I think is lower than what Tesla will need for nationwide adoption. And I kind of approximate that at one accident in a million miles. Like I just don't think the two are comparable. You know.
I think they're going to be held to the same standard. And you're right, maybe nationwide, it'll have to be a little bit better than 100,000, but um, I think it'll be roughly the same standard. And as we know, Tesla's only starting in California and Texas. Um, so they're going to start ramping up just there. And I think by the time they're ready to expand, it's going to be better than Waymo because they're also going to be driving on different roads like rural areas, which have less accidents.
So here's the other point before I go to Joey. Tesla vehicles not using autopilot technology have about 1.3 million miles between accidents. So just the safety, just passive safety alone has 1.3 million. So why would you start it if you're um, why would you start at 500,000? Right. We've all seen the tweets and the explanation and threads about how this data, or like the Tesla data, can't really be compared to 500,000. And there's some good points in there. Newer fleets, clientele is a little different, etc.
Yeah, I just I don't honestly don't think that makes sense because just because Tesla is making safer cars, I mean, a lot of people that would be in these robo taxis wouldn't own a Tesla and might not even own a car. Um, so I
But
don't
see,
think
what I'm trying to say is, if Tesla vehicles without autopilot technology can do 1.3 million, and your FSD is doing 500,000, then your software on its own, without human supervision, is doing worse than human plus passive safety for the same fleet.
yeah, but you just need to compare it to the average driver. Just
Yeah,
because
I
Tesla
don't
has
think
a
so.
higher standard.
All right, Joey.
Yeah, man. When do you think that Tesla FSD will cross $1 billion run rate in revenue?
It may already have. Let's see, 1 billion divided by, let's say, $1,000 a year. You're looking at 1 million users. So that's just subscriptions, and they also selling some. So maybe it already has, or maybe 2025.
Okay, then how about 5 billion?
So 5 billion annualized revenue. You're going to need um, international expansion. So you're not going to get approval in Europe. So you're going to need approval in China, and they obviously have their own automakers working on the technology. So you may run into the same issues, especially in a situation where you have tariff wars, a potential tariff war. That's one of the things that Chinese government can use against the U.S. government. Um, but let's say you don't get China in Europe. Let's say if you can do it in North America. Hold on one second. Let's say if you can do it in the U.S. alone. So 5 billion. The problem you're going to have there, I think, you're going to have to lower the price of FSD, say $49 a month, so $500 a year, because not everybody really uses for the 12 months. A lot of people just use it for a trip, or kind of get it for a couple of months, maybe do the road trips, and then they cancel. And I think subscriptions will continue to be the primary way people use FSD. So $500 a year, $5 billion. You're looking at, is that 10 million users in the US and Canada? So I don't think that's going to happen anytime soon.
Do you think they'll have any revenue for robo taxi miles driven without a human?
No, no. I think
Um,
they'll probably get to 5 billion annualized revenue without robotaxis. There's not going to be robotaxis for another 5-10 years.
why are you confident that it won't be for another 5-10 years?
Because I think you need, like I said before, one accident per 1 million miles, or 99.9999% reliability. So 6 nines of reliability, and currently Tesla is between 1 to 2 nines. And if you go from V10 to V11 to V12 to V13, it all lines up with the theory that you need 10 times training time to have the error rate of an AI model. And um, right now they're at 95%, 96%, let's say 95%. And so how many halvings of that do you need to get to 99.99? I think it's about 14 or 15. So you need 10 to the power of 14, 15 training clusters, which means um, which means that's like, even assuming, okay, um, like if all cars are equipped with hardware 3 or hardware 4, let's just assume that for a second, you're going to need 10 to 15 times training clusters. So you're looking at hundreds of billions of dollars of spend that you're going to pay to Nvidia and others. Okay. Um, let's assume that you can improve that 10 to 15 to like 10 to 13 or 10 to 12, 10 to 12 power, because you're now using the AI 5. So you're increasing compute on the inference side to not need the increasing compute on the training side as much. And even then, you're looking at tens of billions of dollars of spend. So if you do all that math, it comes to about $100 billion by my approximation. I kind of laid out how I think about it, but just go ahead, do your own math on that.
Yeah, and then the other question is, do you think that Tesla will deploy without that reliability you're talking about?
If they focus on, like Waymo is doing, they limit the operational domain, then you can't cherry pick, obviously. Um, cities, and even in cities, it's not going to be, at least initially, it's not going to be like the entire city. It's going to be this route, and then they're going to expand it to this neighborhood, and then they're going to add another neighborhood, and they're going to start with cities, and then go with highways, and start with nighttime, or when there's not much traffic, and then do daytime, then do rain and snow kind of stuff. So it's going to be gradual rollout, just like Waymo is doing, because they couldn't get to one update, the entire fleet wakes up. And but if you go that route, Waymo's route, then how material is that going to be to the bottom line of the company? It's only going to be couple $1 billion of profits a few years down the line, and at 30 times PE ratio, you're looking at 50 to $100 billion of ad. And I value Tesla's robotaxi and Optimus efforts around $200 billion today, when I say $600 billion fair value. So that's obviously all in my estimate. So yeah, you can limit the operational domain. So let's say that's because, like, let's say around Omar's block, okay, maybe the reliability is already 4 nines, because they have a lot of data there. Maybe the AI team has focused on solving his issues. Then maybe you're starting with 4 nines. So to get to 6 nines from 4 nines is a lot easier than getting from 2 nines, if that makes sense. So that's probably how they're going to start. So you go to Tesla FSD tracker and look at these subsets, where and which states, in which conditions, um, the software does better. That's probably where they're gonna start FSD unsupervised first. But I guarantee FSD I mean, in my opinion, I can't guarantee anything, but in my opinion, FSD unsupervised is not going to start next year. And even when it starts, it's going to be a very limited operational domain. Like when I rode Cruise in Austin a bunch of times, it was like a bus route. They were basically doing a loop at 25 miles an hour. Like who's going to use that service? You know, I think Waymo is making some way now in San Francisco, but that's about it. They have their own challenges scaling and everything. And like I said, they have a lot bigger inference compute on board. I don't know if it's like hardware 4, hardware 5, hardware 6 or 7 level, but it's a lot more than Tesla's, is what we know. And they also are vertically integrated into their training computes, with their TPUs, tensor processing units that Google designs and builds. So, Tesla doesn't have that. Tesla has neither. And Waymo also has HD maps, etc. So it's not scalable, right? It's not scalable to the point where they're going to make billions of dollars anytime soon. But at the same time, it's enough to limit Tesla's growth. If they get to tens of thousands of robotaxis in a bunch of major cities, that's enough to limit Tesla's profit margins from robotaxi miles. So either way, it's negative for Tesla investment.
Yeah, I mean, I'm thinking about what you said. I obviously disagree, or I wouldn't be long Tesla. But I think there is the GPU aspect that they have to scale, but then like the software techniques are still pretty arcane around this AI learning. And so I think there's going to be a lot of improvements that way too. But I can agree to disagree.
So you think there will be improvements on the algorithm front that will not necessitate the orders of magnitude increase in training compute? Is that the good summary?
Yeah, that's correct. Perfect summary.
Okay. Do you know any specific paper today that would allow that in the near future?
Um, Not a specific paper, but the quick analogy I'd give is how like CPUs our computers have memory. Like there's virtually no like localized memory for GPUs and how these brute force AI algorithms work. So I think that will be a huge thing is as memory is implemented.
All right. Yeah, we'll see. So are you saying kind of like how would an increase in memory in say AI4, AI5 would help FSD in specific use cases?
Yeah, so I mean specifically I've been driving FSD for 2 years and I still disengage every time I take a turn to my apartment, and it literally just needs memory that this is the 2 blocks that I go into my apartment, and it doesn't need to churn here. So localized memory could be applied across the fleet for that.
But isn't that kind of just relying? So you don't mean the memory on the chip, you mean kind of the map needs to be improved.
It needs to remember users' um, drives.
But let's say two people going to the same block and you prefer one way, the other guy prefers it the other way. Which one are you going to do?
It should be able to have localized memory for that computer, that vehicle.
Oh, so you're saying it's going to be different for each user.
Yeah, yeah. There should be, just like how you buy a Microsoft computer. Your
What do you mean?
Microsoft computer has memory on that computer. Like,
Oh, I
it's
see.
not processing in the database.
I see. Yeah, maybe. I mean, you can tell ChatGPT today, say something like, I want shorter answers. And it remembers that you want shorter answers. You know, I want questions in 10 words or fewer, and ChatGPT remembers. Maybe your Grok FSD will do the same thing.
Yeah, for sure. And I mean, that's like where you see ChatGPT. Like, if you zoom out, like if you're trying to build like a whole project with ChatGPT over months, it has like virtually no memory, you know?
Yeah. But that's not the only problem, right, Joey? Like, let's say it solved that edge case for you. It's going the way that you want in that block. Is it ready for autonomous driving for robotaxis?
No, I agree that there's improvements that need to be made on multiple fronts. I do think the GPUs, like you're calling out, is part of it. Yeah.
Yeah.
I guess just to quickly insert, my timeline is that I think that things will continue improving and actually at an accelerated rate, but I think 2026 is where we actually start seeing some material numbers flow in, and then probably 2027.
And 2026 because of FSD unsupervised or robotaxis?
FSD unsupervised, combination of both.
How much do you think Tesla will charge for FSD unsupervised in 2026, 2027?
I think it'll be per mile. Is that what you're asking?
Right.
Yeah, I think it'll be like more, a couple dollars per mile. It'll be more niche as they're scaling it. Um, and then they'll kind of ride the cost curve.
Couple dollars per mile. Do you think that will be enough? I mean, I don't know. You think people will pay a couple miles per hour per mile?
I think us niche like Tesla users will, and that's the only adoption they'll really get at that price point.
I mean, unless you can go under $1 a mile, I don't think it's going to be material to vehicle purchases or disrupt personal vehicle ownership. Even below $1, I don't think it's going to disrupt vehicle ownership. I think maybe at once you get down to 50 cents per mile, you're looking at something. Because I mean, just imagine, like even at $1 a mile, people drive 15,000 miles a year, right? What am I missing here? So you expect people to pay $15,000 to Tesla?
No, I don't think that they'll pay 15,000 miles per year.
Okay, so how much do you think people can allocate to driving, to riding in a FSD unsupervised per year?
Couple $1,000.
I don't think so. Um, Especially if they also have a vehicle loan payment. Like for example, I used to like I haven't owned a car since 2010. So it's been 14 years that I got rid of my last car. And I owned a car before, Honda Civic. I had a Toyota Corolla lease. And then I was like, fuck this, I'm not paying this insurance payment. But I'm not even using the car in city. And I got rid of it. And I love never looks back. And that was before Uber. And then even when I moved to Texas, where I thought I would, because I was in Philadelphia before, I thought I would need a car in Texas, and I had the means to buy it and everything too, a Tesla. I decided against it because Uber, I was paying $100 to $200 a month, even if I didn't hold back. I still went to all everywhere I wanted to go. Also you can use scooters and everything, which is also part of Uber. Um, so I was paying about $100 to $200 a month to Uber, right? For everything. And I didn't have to worry about the insurance payments. I didn't have to worry about parking tickets or speeding tickets. I didn't have to worry about finding a parking spot. It was always available within a couple of minutes. Um, so you're looking at, $2,000 a year of expense. And what I think people don't realize is that amount will decline in the future. It's not going to increase. Why? Because of EV adoption. As Uber drivers start using EVs, you can buy a used Tesla Model 3 today for $10,000. Okay. And you're going to be able to do the same thing for a used Model Y next year for $10,000 as this new one ramps up. The marginal cost per mile for an Uber driver is going to decline to electricity cost plus minimum wage. Okay. And in Texas, if you're charging overnight at your place, it's free. So it's just minimum wage basically per hour because anybody can drive that car, you know, um, especially if it has, partial autonomy, let's say. You're just sitting there supervising it, right? Um, so let's say you drive about 30 miles an hour and your per mile minimum wage, let's say, is $15. You're looking at 50 cents right there, minimum wage. And a lot of people get paid less than minimum wage. So I don't know. So I think the biggest competition for Tesla Robotaxi network is going to be used Teslas on Uber network driven by minimum wage folks. And I'm still yet to see one Uber driver with a Tesla that's using FSD. So that adoption is going to hit first before you start seeing it with Tesla customers, because they use obviously Teslas way more than the average. They have 5 times more use for FSD supervised than an average Tesla owner, and they're not using it. So let's say, and Tesla will have to share that revenue as well to drive adoption. Tesla will have to lower the price of FSD unsupervised to at most 50 cents per mile, at most, not even $1. But I think it's going to be more like monthly subscription. I don't think they're going to do per mile. I think it's going to be monthly subscription. Let's say $99 a month, and a lot of people just use it. I think there's a lot of churn in FSD subscribers. I mean, I know every Tesla owner I know that subscribes to FSD. Because most of the Tesla owners I know, they have bought FSD or my advice in previous years. But those who subscribe, they try it when they have a road trip coming up, and then they cancel it. So when are you going to get to 10 million people using FSD, paying $1,000 a year? So that's $10 billion of revenue, and not all of this profit. Let's say 80% margin, $8 billion gross profit. and then you have a tax applied to that, let's say 20%, you're looking at $6 billion of profit, net profit. Times 30 is $180 billion of market cap. When are you going to get to 10 million users of FSD supervised or unsupervised? I don't know. But
Yeah,
one thing people miss is that most people in the US, they don't have extra $100 a month to throw out for luxury. Most people know how to drive.
but Tesla owners do. Do you agree with that?
Tesla owners do what? They have? Well, now they do, right? Maybe a lot of Tesla owners today do. Don't forget that some of these people bought used Teslas at $30,000. Um, I don't think an average $30,000 vehicle owner has an extra $100 a month to pay for a luxury. Model X owners do. And if you're trying to get to 10 million owners, as opposed to like in the US, 3 million, 4 million, you're going to have to drive down your ASP anyway. So now you're talking about people who can buy a $25,000 car, and they may not have $100 of extra. So
Yeah, I guess I look at it more of like there's 3 trillion miles driven in the US, and so like what's the low hanging fruit to kind of try to steal from the less price sensitive those miles to autonomy, and then try to push forward the cost curve and adoption.
yeah, I mean, your first users are going to be Uber drivers. They have 5 times the use for the same monthly price. Libby Palm is asking, what do you use for long journeys? Long journeys. Planes? I use planes for long journeys. Or trains. Or buses. Which I don't really take too many long journeys though. All right. Sean?
Let's just say they hypothetically solve full self-driving tomorrow. I think a lot of people are forgetting 70% of the vehicles are hardware 3, which can't do it anyway. So they're still having a problem ramping up to get to those numbers regardless.
Yeah. Yeah, I think Tesla already knows internally it's not going to happen with hardware 3 or hardware 4. I mean, I agree with Machine that I think the first to make $1 billion in profits for Tesla is going to be Optimus versus robotaxis. I think robotaxis are a lost cause for Tesla. I wouldn't assign much value to it. That's why I say 200 billion Tesla automotive fair value, 200 billion energy, and 200 billion other. So that's FSD, Optimus, and anything else you want to throw in there. But Optimus, they don't have their supply chain set up yet. That's going to take several years. They don't have a final hardware design. That's going to take a couple of years of testing in their internal factories. So, a couple of years in factories, couple of years building out the supply chain and ramping production. So you're looking at again 5 to 10 years, just like Tesla robotaxis, for it to have any sort of material feature. Not to mention that I think the probability of Optimus project being canceled is not zero. Like people assume these things will happen regardless, no matter what, etc. But think how you felt about solar roofs back in 2016. There was a big event. The product looked viable. Management commentary was very positive. It was presented as a critical piece of the puzzle for sustainable energy, and it looks beautiful. And there were many comments over the years about how they're ramping production, how it's going to be version 2, version 3, the price, and how millions of houses and everything. And in the end, it's got scrapped basically for various reasons. It wasn't a priority. Um, Solar panels from China was a lot cheaper. Solar panels on the roofs became more efficient, better looking, thinner, more reliable, and Tesla ended up focusing on other things. And I don't know if you guys remember, but it's like, we ramped it to 1,000 a week. It's like, never happened. Where is it? It's still super expensive. So it wasn't a focus. And like I said, Solar Roof was presented as a critical piece of the mission, which you can't really say that about Optimus either. So further, there was no Nvidia, Microsoft, OpenAI partnership competing against Tesla Solar Roofs. Now you have that on Figure AI, and you have other, like even BYD is now building a humanoid team. So I don't know. People say Tesla's manufacturing capability will allow it to beat the Nvidia Microsoft OpenAI partnership for Figure AI. Fine, maybe, but at the same time, what do you say about BYD's manufacturing capability? BYD ramped several vehicles way faster than Tesla has ever ramped any vehicle. And their cost production per unit is way lower than Tesla's in China. And the only reason why they're not in the US is because US government is protecting Tesla. Tech Greg?
Yeah, back in 21, I went through the whole process of getting a solar roof. And literally, be, I don't know, right before I was supposed to execute the contract, it went from 42,000 to 78,000. And I canceled the order. That was when they were figuring out that they were losing money on each roof and they couldn't put it. And I never ended up getting solar or anything after that, which was very was disappointing because I was really looking forward to getting it.
Yeah. So I strongly believe any material revenues from FSD unsupervised / robotaxis, in my opinion, they're basically the same thing. FSD unsupervised robotaxis and Optimus are 5 to 10 years away. Tecker, you have to mute yourself where you're not talking. Thank you. 5 to 10 years away. And who knows, like the further out that goes, the risks compound, right? The risks to those cash flows compound the further out in timeline you go, because you have potential competition that may come. There are potential recessions. China may go into Taiwan. Elon may move on to XAI or get abducted by aliens or whatever. So the further out your timeline, and I feel pretty strongly this, like 5 to 10 years out, the riskier the cash flows, projected cash flows. Joey?
What do you think their revenue will be in 5 years?
I don't know. I don't know.
Yeah, I think the solar is a good point. It never worked out, but then you look at their revenue in
I mean,
26.
look at it's not just a solar roof. Look at Tesla Semi. I
But I
remember
guess
the
I would.
first. I remember the first announcement in 2018 when it was first announced. The stock jumped like 10-20%. 2018. It was beginning of 2018. That was 6 years ago, and we still don't have them in any material numbers on the roads. 4680 when it was announced in 2020, it was supposed to be what was it, 100 gigawatt hours by 2022? Nowhere close. And you have the CATL CEO saying, Tesla can't do batteries. It's a competitor, so take it with a grain of salt. Um, the head of this 460 project left the company. It's a limited factor on Cybertruck production profitability and also standard production. And they're not vertically integrated. They still depend on CATL for their batteries. And CATL doesn't depend on Tesla. So I don't know. So I don't know. I mean, we've all seen the list from Tesla Q Bears, the Semi, the 4680, Tesla Solar Roof, and everything. It's just well, my point is Optimus or robotaxis are not 100% certainty. So whatever cash flows you see online, you can't take it at 100% certain. You have to apply a high discount rate to those things. So Joe, go ahead.
Well, I think you're making good points on solar and the et cetera that you're talking about. But if you look at what 2018 revenue was 20 billion, and they still made their way up to 100 billion now. So I guess I think there'll be similar struggles, but I think they'll increase revenue at similar order of magnitude over the next 5.
I bet you that it won't be similar order of magnitude. So let's see. So what was it 2018 and what is it now? Revenue per year.
2018's 20 billion,
Mm-hmm.
21 billion, and then 2023 is 96.7.
Yeah, so 5x.
Yeah,
So
roughly.
you're telling me it's going to be $500 billion. Actually, that may happen, maybe. But what was the increase in profits, free cash flow, 2018 to today?
Let me look at this little macro trends.
It's about zero, right? It was about zero then. It's about zero now. There was no free cash flow in 20. They were still raising capital. And today it's about $3.9 billion.
Yeah, 2018 negative 0.976 billion, and 2023 14.99 billion.
It's not free cash flow. Going 23 free cash flow is not 14 billion. You're probably looking at GAAP earnings.
Net income, yeah.
Yeah. And GAAP earnings, as you know, have the reversal of the valuation allowance for deferred tax assets. So you have to take that out. So that's why I'm looking at free cash flow. So what do you think is the value of a company that's generating $1 billion free cash flow a quarter and needs tens of billions of dollars to get to robotaxis?
Yeah, I mean that's not how I typically value a company.
What do you mean? You don't look at free cash flow when you're valuing companies?
No, I'm more a growth investor.
Okay. You don't think growth investors look at free cash flow?
I guess some do, but I don't think I don't have as much of a weight on it. I mean, I like to see when like Salesforce has like some really nice free cash flow. But that's more a safe play in my portfolio.
All right. I see Wes in the crowd. If he's available, if you could please come up. I have a specific question for him about FSD. Oh, look at that. I think the Fed just announced their decision. So let's see what this decision is. Fed cuts 25 basis points as expected. Okay. Why are the stocks down then? Maybe something in the shows 50 basis point cuts in 2025 to 3.9%. Longer run at 3%. Huh, interesting. I think that's it. Yeah, that's 2 point. It was 2 point now, so they increased it. That's interesting. I guess I should check my portfolio of 2 dozen shorts now, see how we're doing here. Yeah. All right. Let me see some commentary about this Fed decision. And then in about 25 minutes, we're going to jump into the earnings, the call, the Fed call. We're going to watch it on YouTube. So if you're on X, I recommend heading over to YouTube to watch the Fed Fed presser in about half hour, 25 minutes. Tesla's at 1.2%. Let's see. Fed backtracks on 2 hikes in 2025, moves them out to 2027. Okay. PC inflation, September projection was 2.1% in 2025. Now it's 2.5% in 2025. That's a material increase in the inflation forecast for next year, which indicates obviously being hawkish a little bit. Core PC is now expected to be 2.5% in 2025.
Yeah, so Yaman, when do you think the next cut will come after this now?
I think the next cut will come after a recession. Recession starts. So the Fed cuts rates by 25 basis points as expected. Cleveland Fed president dissented. Interesting. So there's a dissent by the Cleveland Fed president, Beth Hammock. The SCP shows a solid median of 2 cuts in 2025. Officials also revised up their end 2025 inflation projection to 2.5, like I said. Median long run dot rises to 3.0%. Interesting. The policy statement hints at a slower pace of cuts by adding the phrase the extent and timing to modify potential adjustments. In considering the extent and timing of additional adjustments to the target range for the federal fund rates, the committee will carefully assess incoming data, evolving outlook, and the balance of risks. A very minor change, just that added. So the extent and timing of additional adjustments. Yeah, it looks like the biggest changes here are in the SCP, the increase in inflation forecast for next year, and the longer run federal funds rate went up from 2.9% to 3.0, which has been creeping up. So interesting. Trying to see if there's anything else here. So they're at 4.25 to 4.5 now, and they think longer is going to be 3. So they believe it's about 125, 150 basis points to restrict right now. So about a few more cuts, a handful of cuts. And 2 of them they said will come in 2025. Interesting. Yeah, I mean, I think that there will be a recession soon, starting soon. And the primary risk to that is something like, they achieved something like 1995. So I'm looking now, researching some comparisons and contrasts between today's economy and the economy in 1995. I think the main difference is that in 1995, inflation was clearly under control. Today, especially now that you see that in the SCP forecast, SCP schedule, um, even they are increasing their estimates of inflation for 2025. So I think the home price will have to drop substantially to bring inflation totally under control. And at that point, you're risking spending, consumer spending in the economy. As people see their home prices decline, they may be more hesitant to spend money. So I think this is the final cut for a little bit, and then we'll see. And that obviously means mortgage rates staying above 6%, uh, or the loan rates staying about 8, 9, 10%, and that's the new norm until further notice. So if all the loan rates stay high, then Tesla doesn't sell full capacity unless they continue to bring prices, but their gross margins are already low. So there's limited room to cut prices, limited room to bring new affordable models, scale them. I think Tesla's gonna have to scale these new affordable models at a pretty gradual pace throughout 2025 at these high interest rates. And there's no uptick in FSD take rates right now, any material uptick in FSD take, like went over in the first half of the space. Getting to several million FSD users is going to be a while, and they're going to have to cut prices of FSD to say $49 a month, and I think they're going to have to include it for free in every car, just like ChatGPT now did, or Grok did. It used to be just premium users, premium plus users, and then premium users, and now everybody has access to Grok. And OpenAI is also expanding some of their premium models to everybody too. So because they need the data, right? It's a chicken or egg problem. Tesla is down to -2%. Nvidia down quite a bit as well. Let's look at Bitcoin, which impacts MicroStrategy. Bitcoin is down to 103,000. So I know Joey said earlier that he doesn't look at free cash flow, but a normal free cash flow from a value investment perspective, a normal free cash flow multiple is about 10 to 20 times, especially at these high interest rates. And so if Tesla is generating $1 billion of free cash flow a quarter, 4 billion, 5 billion a year, times 20 is $100 billion. From a value investing perspective, Tesla's fair value today is $100 billion, not $1.5 trillion. Unless you argue that robotaxis and Optimus is around the corner, like literally a year or two out at scale. If that's the case, then you can ignore historical statements. But if you don't believe that's the case, like I do, then you can't ignore, especially in a recession or liquidity crunch, which I think is possible in the near term. You can't ignore the possibility of Tesla stock being valued at normal valuation multiples. I think the fair value of $600 billion, $200 billion automotive, because I think interest rates will continue to come down, which I can't support after today's Fed meeting. I think that energy is also worth $200 billion, even though Tesla will face very significant competition in energy storage systems in China and elsewhere. And there's regulatory hurdles in US. So even if you assume the US government will clear the regulatory pathway for energy installations in the US, they can't do that in China. Trump can't ensure FSD approval in China and Europe. And I think that there will be algorithmic breakthroughs like the transformers. So in the other bucket, I don't think robotaxis and Optimus at scale are more than a decade away, but they are at least 5 years away, and maybe as much as 10 years away. So 5 to 10 years, even assuming a significant algorithm breakthrough like transformers, which I can't support. So even with those optimistic assumptions, I think the fair value of Tesla today is $600 billion, not $1.5 trillion, and that's why I'm short. Joey?
Yeah, I guess I'll just ask you a parting question on the economic front. So it says 4.2% unemployment in 2024. I wrote an article. My big thesis is that unemployment is going to tick up higher, which is going to make them cut a lot more than two rates next year and even more into 2026. What do you think unemployment will be at the end of 2025? Or what's your employment outlook?
I think unemployment will continue to rise, and but you can't really know how far it's going to rise. Like you don't know how far. Like if there's a like you can I think you can kind of like forecast a recession beginning, but forecasting how deep it's going to be is much harder to do because it depends on policy changes, both on the fiscal front and monetary front. So we're gonna have to do it live basically as the decisions come in. But as it stands today, nobody, I mean, I shouldn't say nobody, but most people are not worried about a recession in 2025. We just swung from 100% economists forecasting in 2022 a recession to almost nobody forecasting a recession for next year, even though I think the probability of recession is much higher today than it was in 2022. I was actually saying there is no recession in 2022 or 2023. And if you look at the sentiment surveys and everything, everybody's bullish. Like everybody's investing in market, cash on the sidelines or in portfolios is much lower. At like historic lows. Credit spreads are at historic lows, meaning money going into risky investments are kind of like part of like 1999. Um, you know, so and the benefits of AI are flowing, the productive benefits of AI are flowing to top companies like Meta or Amazon, Microsoft, but they don't need to hire as many people. Like most of the hiring comes from small firms, and they're not yet seeing productive benefits due to AI, or they're not implementing it as fast as these big companies because they don't have tens of billions. Even Tesla isn't spending tens of billions of dollars to build FSD or build Optimus that would increase internal productivity or productivity of its drivers because it doesn't have tens of billions of dollars. So I think there's going to be a liquidity crunch as the unemployment rate increases. People start believing, or companies start believing that there's going to be a recession, and then it kind of snowballs. They've already stopped and they already slowed down hiring at a very rapid rate. Today, somebody who loses their job has a much harder job, like twice as hard of a time finding a new job versus somebody who lost their job about a year ago. So companies are in a wait and see mode, but as long as they see their stock prices increase, then they may not lay people off. But I think that that's coming in the near term. I think the layoffs are going to tick up in the coming months. Not even quarters. I think Q1 is like, I mean, I used to say end of 2024. and maybe it'll be end of 2024, but maybe, so December, January, February is when the recession starts, I think. I guess we'll see. I tend to be early on those things, so. But I think there are several reasons why Nvidia is going to see the largest market value decline in the history of the stock market. I think we're looking at $2 trillion worth of value decline for Nvidia in the coming year too. So I increased my short position on Nvidia this morning. I already have large positions, short positions in other stocks as well, but Nvidia is now a very significant short position. All right, 10 minutes to the Fed presser. If anybody has any questions, now is the time. Otherwise, we're going to watch the Fed presser together on YouTube, but the first half hour. Usually the good questions are in the first half hour. Learn Code, Sean, or Tech Greg, any questions, comments? Libby Palmer says, you say interesting a lot. I agree. I do say interesting a lot. I also say amazing a lot. If you have noticed. I just find things very interesting. All right. I mean, maybe I can also do it in X. I'm not sure how that would work, but no, that probably won't work. Let's do it on YouTube. Let's look at some commentary for the next couple of minutes before we head over to YouTube. Fed expects fewer 2025 rate cuts. The Fed's latest dot plot projects fewer rate cuts in 2025 than central bankers were expecting in the previous forecast from September. The median Fed official now expects the federal funds rate to finish 2025 at 3.9%, two fewer quarter point rate cuts than 3.4 level anticipated in September. Fed officials also grew more concerned that inflation will remain stubborn next year. I mean, this is exactly what I've been saying, basically. More inflation will lead to fewer cuts, and that's going to lead to a recession. So if the stock market's turned down, let's say, for example, the stock market is going to, just for example, for illustration purposes, if stock markets go down in the coming weeks, say 10%, 20%, then you're going to start seeing a surge in layoffs. And that's when you have a recession. And yeah. And that's why I have a short portfolio, 24 stocks shorted and no longs. US Treasury 10-year yield hits fresh 4-week high, up 6.9 basis points to 4.45%. 10-year yield has a 98% correlation with mortgage rates. So that means mortgage rates going to surge as well, or at least stay high. And we're already seeing a very rapid increase in home inventories. So the next up is price declines. And that means wealth effects and all that stuff. Two-year yield is up 7 basis points to the highs of November. Interesting. And that 5-year yield is up 8 basis points. 5-year yield is the one that has most correlation with auto loan rates, because the average duration of the payback period for auto loan is about 5 years. Five minutes to the Fed presser. GDP now forecasts Q4 seasonally adjusted annualized rate of GDP growth, real GDP growth, to be about 3.2%. But as you remember, Q4 2007 was also about 3-4% growth. And that's right before the recession started. So it's a bit of a backward looking metric, especially with all the adjustment that comes to GDP growth afterwards. All right, I'm going to pin the link to YouTube to the top of our screens on X, and then I'm going to switch to YouTube. And we're going to watch the Fed presser together. Yesterday, I said the wide release of FSD is a positive for the bear thesis, not the bull thesis, because the hype is around all the positive news that comes around just a handful of users that have a massive incentive to be positive about FSD. And today, we're seeing a lot more negative takes on FSD 13, in line with my forecast that FSD 13 will drive in about a year. FSD tracker, in my opinion, will show 96% and 97% drives completed without a critical intervention, up from about 94-95% today. The link to YouTube is at the top of our screens. Steven says, I'm leaving my current job on December, and I have 3 job offers on the table, all within a week. That's great, but that's anecdotal. The data that I consider is nationwide and is very up to date per week. So that's millions of Stevens I hear from, as opposed to one Steven who has a long position in Tesla and other stocks. All right, I have the presser ready to go. We have 2 minutes. Also, Steven, unless I'm sure you do great at your job, but I wouldn't change jobs right before a recession either, because you're going to be the new guy in the new firm. All right, 1 minute. to the Fed presser. We're going to watch it on YouTube through the link at the top of your screens. You can join me there. All right, here we go.
From its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smilik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those 2 risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem towards the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I'd say it is this: some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down. And so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation, September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation to as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you there's some language in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that. That may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but it would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence, or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, we've made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought, 2 years ago. But it's nonetheless steadily coming down as market rents, start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on. And, our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. Job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So you're right, though. And I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks to the two are we think are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase, and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation. And that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month, I think, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course, that's part of what we do, but we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so. No, I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation, and that's part of the reason that explains why we moved ahead today with the action with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high, wages are at a healthy and ever more sustainable level, wage growth, and so the labor market. This is a good labor market, and we want to keep it that way.
Thanks.
Amira.
Thank you. Amara Mokoy from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way in the strong position that you have described without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
You know, we can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates. And we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. You know, job creations are meaningfully positive. Wages are, you know, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because if the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and you know, we pay close attention to it, and it's worth noting that it is still gradually cooling, gradually and in an orderly way. And you know, that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected? You know, it breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to had a deep recession and, you know, high unemployment by now. Well, that has not been the case. So, you know, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, you know, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but you know, what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that, and it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning, you know, big real wage increases, so that their wages are going up, their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for. And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration? I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes, where is that neutral rate?
So I'll say a couple of things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, That's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously. Now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation; they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down, but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
We monitor geopolitical risks really quickly, but really carefully rather. But
I would say so far those risks haven't really, nothing has come out of those risks that really has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, and but that is a good summary statistic for the kind of thing that could go wrong in with global turmoil. But the price of oil has been coming down, and because of supply conditions, global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't react to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation. And it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now. And we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up, let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now. We're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways, appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's
that's meaningfully restrictive. And I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So thank you very much.
Thank you, everybody, for joining. And I thought that was a really good Fed presser. Powell wanted to, convey confidence that he believes the economy is doing well, and that he expects another good year next year. And what's kind of outstanding for me is whether he actually believes that, or if he's just trying to convey confidence, because the economy has a way of kind of becoming a bit, the vicious circle down in this situation. So I'm going to give him the benefit of the doubt. Maybe he believes that the economy will actually, continue to grow next year, but that's not my base case expectation. I think especially if the stock market reaction that we're seeing today, if that continues at this pace for another few weeks, and the markets come down, they're at record levels right now, and I agree with the Fed that the inflation is proving to be a bit more sticky than than estimated earlier. So they revised their inflation forecast for next year higher pretty meaningfully, signaling a bit of a hawkish stance for rate cuts in the coming periods. And they also increased their longer run estimate for the Fed funds rate from 2.9 to 3.0%. I think that used to be about 2.5% about a year ago. So that's gone up by about 0.5%, which is very meaningful because that's like increasing gravity. So I think the policy is more restrictive than people realize today. And it's more restrictive by about 1.5%. And on top of that, there's also quantitative tightening going on too. So, call it 2% total restrictive versus the underlying inflation. So, I think the next stage is home prices will start coming down. And when home prices come down, and if the stock market is also coming down, people are seeing their 401ks decline, home prices decline. I think they're going to, start cutting back a little bit on spending. And we're already seeing that in the consumer spending during the holiday season. Holiday season is slightly weaker than last year. And this is reflected in retail sales, but also in temporary hiring. So I don't think the economy is as strong as people think. And I think next stage is home price coming down, stock market coming down, and initial the layoffs will, I think, increase from here on out. So I think this will play out in the next few months, potentially a few weeks, but probably more like few months. I tend to be a bit more like things happen slower than I expect. So maybe throughout next year, I guess we'll see. But at a minimum, the current environment we're seeing right now, the yield curve has jumped by about 10 basis points after this presser, after Fed's decision. Let's take a quick look real quick on, let's say, the 10-year yields. And I think that was also mentioned. So that's up 11 basis points. And that's relates to, as we've been discussing in TSLA Live, that relates to the mortgage rates quite a bit, which the chairman also mentioned today. And the 5-year treasury yield relates a bit more to car loans. So that's up 14 basis points, which is incredible. So to the extent that Tesla and other automakers were offering these low rates, but the market rates are coming, increasing, that the loss per finance per vehicle, per 0% financing offered per vehicle is going to increase. And that's going to pressure margins. This is true across the industry, which is why I have a short position on Tesla, a short position on GM, and a short position on Carvana and Rivian as well. So 4 short positions on the automotive sector. I also have a short position on Toll Brothers and the housing sector. I think mortgage rates will stay high and home housing demand will remain low and home prices will decline next year, probably faster than people realize. And on top of that, I have short positions in Exxon and Palantir and let's see, and MicroStrategy. These 3 I would and GME and EOS. These 5 I would put in the bucket of like just overvaluation for what they are. And I think Palantir is a great company. I think Carvana has the potential to be a great company, and Exxon is a great company as well. But their valuations are just off the charts. And like Exxon, for example, obviously huge benefit to the society fundamentally, but their CEO has been selling hundreds of millions of dollars of stock at much lower prices, by like half, like $200, $300 share per share prices. And today, Exxon stock is at $617 per share. So the CEO himself didn't think the company deserved that valuation 2-3x ago. And since then, the stock has increased. It was just recently added to NASDAQ 100 index along with Palantir and MicroStrategy. And maybe because of front running for those inclusions, these stocks surged. But I think they're going to come down similarly. Carvana has an interesting situation. They're not profitable. And their PE ratio is absurd, kind of meaninglessly absurd. And I think Carvana in a recession would also, both financially because of the demand for the stock, but also operationally would decline quite a bit. So I have a short position in Carvana, and GM is, it's from traditional valuation metrics, it's about 6 times PE, very cheap stock traditionally. But they just canceled their, supporting their cruise development, which I do think the future is autonomous in 5 to 10 years. GM also has made very significant investments into battery production and EV models. We're talking, billions of dollars of invested already, and with not much to show as a result. I think Tesla vehicles are still the leader in the industry, and GM still suffers from innovator's dilemma. And in a recession, people will buy less large SUVs, which is where GM makes its money. So the stock has run up by about 100% in the last year, and I don't think that's deservedly so. And on top of that, GM buys back stock. So to the extent that you believe GM's price is above its intrinsic value, buying back stock destroys value. So I just increased my GM short position as well. I have some other small ones like, just like Lemonade, which I added to my position today, and let's see, Rocket Lab, which is down 10% today. These are kind of just, I think, companies that had a shot at becoming a real business when the interest rates were low, but they didn't quite make it there, like Rivian. So that's part of but I don't know these 2 companies as well as I know Rivian and the other companies I counted. So those are small positions. GME stock has surged. I have a short position on that as well. GME stocks has surged because of Diamond Hands, Take Two. But like we see in every movie remake, I don't think this remake of GME short is going to be as fun as the first one. I think it's going to be cut short because of these high interest rates and the recession that's coming. So thank you for the comments of good call in the replies on Twitter, on X, on YouTube. And appreciate that. And I'll probably be adding back. I think there might be some sort of a bounce, maybe. I don't know. I'm kind of hope because I still have a bit of a dry powder here. If there's a bounce, I'll keep shorting. Maybe I'll add a couple of shorts. And some of these are playing out sooner than I thought. So I may close those positions, add to other positions. So every time I make a decision, I'll let you guys know on X, on YouTube, in Tesla Live, and the reasoning as well. I highly recommend people to join Tesla Live every day and request to speak and ask questions. And I'm happy to share my research. All right, thank you very much, everybody. I wish the best for everyone, and I'll chat with you all tomorrow. Take care.